Hey there, we're live. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream, all about personal finance, investing, the economy. We get into the weeds here. I like to get into the geeky stuff, the nitty gritty, and let you know what's really going on. And we talk about the stock market, Federal Reserve, interest rate policy, economic policy, other central banks, Bank of Japan, Bank of China, Bank of England. We talk about it all here. Just we cover so much stuff. I get asked sometimes, how do you come up? Okay. How do you come up with so much material with so many things to talk about? Because I don't really try. There is so much to talk about. There's always something crazy or scandalous or something going on in Wall Street, FTX, or you know, and there's always something going on. You can't avoid it. So if you're while you're watching, if you wouldn't mind giving us a thumbs up or a heart or a like, and just let us know you're out there. And when you give us a like, you help spread the word to the rest of your contacts and social media that you're watching, that you find value in what we do here. And it's just really good for us. And we really appreciate it. It helps encourage us to do a better job for you. And if you have any questions while you're watching this, definitely hit me up in the comments. I love to see you there. I love answering your questions. I love hearing from you. Just words of encouragement, words of wisdom, or insults, whatever, anything you want to put in there. I always appreciate, and it's fun to hear from you. And it's the best part about doing this. Okay, so we're going to talk about the market. It's just the same old, same old. Couple of things to go over, and we're going to roll the introduction, and we're going to talk real quick about why does the market keep going down? What's the deal with the recession in the first half? And maybe you need a way to buy here because we don't know what the bottom is. It could be close at hand, it could be far at hand. But I do know that there are values appearing daily in the stock market, good investments, and we need a way to buy these and take some of the fear out of it and maybe even um, take the fear of, quick downside out of it too. So let's roll a quick intro. We're going to talk about these things now. All right. Thank you so much for joining me. If you're just tuning in now, I'm Mitch Goldberg. We are just getting started. Today, another down day in the market, January 5th, 2023. So the year is off to a pretty rocky start. I heard somebody say, yeah, well, the year's going exactly like consensus said, that we'd have a down market in the first half and an up market in the second half. First of all, we don't know what kind of market we're going to have in the second half. And I would not want to make a judgment for the rest of the first quarter or first half of the year or whole year based on 3 days of trading. um, hmm. I know some people like to think, if we have a, a good January, where it means a good year. If we have a good first week, it means a good January and good quarter. I think all of that stuff is actually BS. In other words, I know that those are often the cases statistically, but they happen. They're wrong enough to completely throw you off and wreck all the good returns you had before. These are rules of thumb, not not gospel. They're not really a consistent, reliable guide. And if you want to make bets like that, caveat emptor, right? Buyer beware. So let's just go into this quick. The Dow was down again a couple hundred points, down over 300 points. It was down over 400 points at one time. So the S&P, the Nasdaq, they were down too. Okay, you can't invest directly into an index, but you could invest in a security that tracks your mimics an index. So why were they down? Because yesterday we saw the Fed minutes that were from the December meeting last December when the Fed last raised rates a half a point. And in the minutes, like you have a meeting, someone records the meeting, the minutes of the meeting. The Fed chairman, Jerome Powell, said he thinks it's a mistake for investors, for all economic participants, to not take the Federal Reserve's resolve in tamping down inflation to its 2% target. And they are willing to leave rates higher and raise rates more. And they're willing to leave rates higher even if we do see inflation come down meaningfully. It's actually the mirror image of when Jerome Powell said, we will cut rates, stay lower for longer with interest rates until we see the whites of the inflation eyes. Well, he did that. And now we have a lot of inflation, although it is calming down. So take him serious. If he says he's going to keep rates high to push inflation down, to tamp it down, and he said he's willing to overdo it, you should take him seriously, because you would have done well in the past taking him seriously, or at least you would have had an alert system, so to speak. So today, the first-time unemployment claims came out a lot lower than expected, which is actually a bullish thing for the economy. So fewer people claiming unemployment, but it means the labor market continues to be pretty strong, and it reinforces that the Fed is going to keep rates higher, keep money supply tight for a longer time. Now, tomorrow morning, we are going to get the unemployment report, the non-farm payroll report, and that is the broadest picture of the health and strength and or weakness of the labor market. It comes out every month, and every month until this time, until today, the day before, investors work themselves up into a frenzy, and they think, oh, we're going to get a lower than expected unemployment figure or higher than expected unemployment figure. That means the Fed's going to pivot, then they're going to cut rates, and we're back off to the races in the market. And investors just get kicked in the head every time they do that. It's like Lucy always pulling away the football from Charlie Brown. So I don't want you to get caught up in that. All right. And I think finally investors are starting to realize that, you know what? Employment's pretty sticky. It's pretty strong in spite of the Fed raising rates. But the Fed needs employment to weaken a little bit to drive inflation down. So today is just another reminder that inflation is pretty strong, the labor market's pretty strong, and the Fed is going to stay tighter for longer, higher for longer in terms of interest rates than people anticipate. But every month, everyone gets themselves into a tizzy and says, oh, they're going to cut next month, or they're going to stop raising rates because we're going to get just the exact right economic statistic that's going to change everything. You know, folks, it's not that easy. It doesn't work that way. The bottoming of a bear market is not an event. It's a process. It's a process that we have to go through before the bottom and after the bottom so that we can actually make progress toward new highs eventually in the stock market. All right. So I just think you have to acknowledge that the Fed is in control of raising rates. That's what they can do. It's the one thing they can do, and they want to slow the economy down, possibly push us into recession. Leon Cooperman was on CNBC before talking about saying he doesn't believe in a soft landing. He thinks he thinks we go into a recession, hard landing. Okay, one of the most astute investors in the planet. All right, so that is that. I also want to talk to you about something. We're going to take a look at the market update, and I want to talk to you about Tesla real quick. Tesla's like the stock on everybody's mind. And then we want to talk about buying in this market. But first of all, I was asked a question by a friend who, all right, she would like to retire early, and she wants to stop working by about the age of 50. And this is someone he's got about 9 years until she reaches 50. But at 50, she wants to quit her job and start taking money out of her 401k, out of her IRA, because she's going to roll her 401k plan over to her IRA. And she wants to know, can I take money out of it and avoid the 10% penalty? And I said, yes, you have to do something called the 72T rule, 72T like Tom, where if you take the money out in equal installments, okay, then for at least 5 years straight, then you could do it. You get out of the penalty. And if you do a 72T, even if you start, let's say at like age 58 and you go to like age 59 and a half, you can't stop the 72T. You can't stop the withdrawals, even though you're past the point, 59 and a half, of which you have to pay a penalty, a 10% penalty to take your money out of your IRA. Okay. You roll over IRA, whatever, however you want to, either IRA or roll over IRA, same thing. So that is something I think, it's a good personal finance question. And the idea for this client is to get to the point of collecting Social Security at around the age of 65. We'll see. This is not my client actually, so it's just a friend asking me about how to get money out of a IRA before you're 59 and a half without paying the penalty. It can be done, but there's rules you have to follow like everything else. All right, so let's take a quick look at Tesla. All right, Tesla was down another $3 today. It was lower at one point. I don't know if you could how well you can see this. Let me make this a little bit bigger. Okay, here's Tesla. That's better. All right, so the stock was down to about, I think, 105 earlier today. So it had a nice bounce. It was off about 10% on the day. So it had a nice bounce off its bottom, but 110, and the stock is down, I don't know, over 10% year to date. And everybody is talking about it because the fall in the stock has been just, stunning. So let's take a look at the chart. This is a 6-month chart. I think you even see it better in a 3-month chart. It's just a stunning drop in the price of Tesla from, let's say 241 down to 110. That's a massive drop, for a company this big, for a stock this big. And what happened? Well, the stock had already been going down. Yeah, I'll blame a little bit of it on Twitter and Elon Musk putting his attention on Twitter. But I'll also blame some of it on the fact that the quality of Tesla cars reports have been that quality is not so great. And I'll also say that they missed sales. They sold like 1.3 million cars in the last year, which is amazing. And if people used to think if they could ever get to 1 million cars in a year, that would be like a miracle and the stock will go up and everything. And well, now they're here and they have to show earnings. In other words, congratulations, Tesla. You are now a real company subject to the rules of financial gravity like everybody else, as opposed to trading on hope. And that is basically what happened. And it's a tough time for the auto sector because interest rates are higher. The price of used cars is plunging. Subprime auto loan delinquencies are skyrocketing. And there's a ton of competition coming now in the EV space. So tough to be a Tesla shareholder. Now, I'm not making a call whether or not you should sell Tesla. Although a friend of mine asked me a few months ago, should I buy Tesla? And I was like, nah, not for you. But it wasn't because I knew Tesla was going down. It's just because I didn't think that this individual really put the thought into the risk tolerance that comes along with it. When somebody just quickly goes, "Hey, you think I should buy it or not?" Like that's the whole thought process. That's when I don't think you should buy anything, no matter how good no matter how good you think it could be. All right. So but what I will show you is they actually did get an upgrade. So Tesla upgraded by Edward Jones as it tumbles for yet another day. All right, so it gets an upgrade. That's great. I don't know if I don't really think Edward Jones is really carrying any weight in terms of their research department. It's not really like an investment banking firm slash research house, but they have an analyst that covers it, and he says buy it as it tumbles. Buying a stock when it's going down is, we call that catching a falling knife. Not the safest thing to do. So we'll see. So I want to talk to you about buying stocks though, because the market's coming down. And in a down market, some of the down stocks will be big rebounds. Some of the up stocks last year will be good sells this year. But if you're going to buy any stock when we're probably heading into, I think we're heading into a recession, remains to be seen. But regardless, by the time we're in a recession, that could be the signal that the stock market's is already going back up. But let me tell you how to buy a stock. Let's say you do want to buy a stock that's, we'll call it $100 a share. And it could be a tech stock, it could be an industrial stock, whatever it is. Maybe you want to buy 100 shares for $10,000, for example. So maybe what you want to do is you want to buy 40 shares now for $4,000 and put a buy limit order below what you paid for it today, let's say 100. So maybe you put a buy limit order, let's say 4% lower at 96 to buy 30 shares. And then another 30 shares, a buy limit at 92. So this way, if the stock keeps going down, you'll get hit with your buy limits and you'll get better prices. The risk is the stock goes straight up to the moon and you never get a chance to buy it. But by and large, more often than not, stocks fluctuate. When you buy a stock, the odds are of you buying the absolute low and the stock never goes lower is exceedingly unlikely and rare. So try buying stocks in smaller positions and use limit orders to fill out the rest of your position, knowing that you might not get filled on the limit orders, but it does give you some wiggle room in terms of making volatility, the ups and downs of the market, your friend as opposed to your enemy. I'd love to hear your thoughts on that, but that is something that I do for clients, and I find it effective and I find it helpful. It also puts a lot of discipline into what I do, because if you say, well, I'll buy it 100, if it goes down 5%, I'll buy more. And if the stock goes down, let's say from 100 to 95, now it's time to buy it. What you'll do is you'll be like, well, before I buy it, let me do some good thinking. Let me put my thinking cap on and let me go look at the news and see why it's down. And if you're in a confident mood, you'll interpret what you read and what you watch as positive and you'll buy it. If you're in a negative mood, you'll interpret what you read and watch as negative and you won't buy it. That's not a disciplined approach. You said you were going to buy it when it goes down a certain percentage. You buy it. That's a disciplined approach. And what you want to do is you want to take the thinking out of it and automate this as much as you can. And that's why I like the approach that I use, because I know I'm only human and, we have to fight our human tendencies. We are our own worst enemies when it comes to investing. I'm experienced to know that. And therefore, I put in rules-based investing to avoid me thinking about every little thing. Because when you have to think about a lot of things at once, what do? You put everything off. You procrastinate because it's too much effort and you go on to something else. Okay. So now let's take a look at the averages. Dow down 339, NASDAQ down 1.5%, down 153, S&P down 45 points or a little over 1%. Gold backed off a little bit, but gold's been on a tear, so that's all right. Oil was down about $3 yesterday. It was up $1 today, no big deal. 10-year yield is up a little bit. The VIX is up a little bit. This is the most surprising thing of this whole market, the VIX. It consistently stays in the low 20s while the market's going down and mega cap stocks like Tesla are getting killed and even Apple's been getting hit. It's really remarkable. And I think the VIX being so stable is more or less I'll say maybe a sign of complacency. And I do see a lot of complacency because everybody's just so convinced with this narrative. Once we get a weak unemployment claim from the Department of Labor, Fed's going to pause and we're back off to the races, and everything we have that went down is going to right back up to where it was and we'll be okay. If you think it's going to be that easy, I have a bridge to sell you. Okay. Let's take a look at the bond market. Bonds were up across the board, yields up across the board, although the 10-year was up a 0.013%, while the 3-month was up 0.1. So even though yields are up across the board, they were up a lot more for short-term bonds as opposed to long-term bonds. Nothing screams louder that we're going to have a recession than seeing the 10-year yield stay under 4%. Nothing screams shouts. It just shouts recession to me when I see the yield in a 10-year not moving up. And since short-term yields are way, way higher, it really does tell you how crazy inverted and how persistently inverted the yield curve is, which is typically a harbinger of a recession to come. All right. So that's my story. That's it for the day. I'm going to get going. I hope you guys have a good night. Thanks so much for sticking with me. I really appreciate it so much. And I typically don't live stream on Fridays, just because I'm so busy and I've got other things to catch up on Fridays. But if something does happen that's really crazy in the market tomorrow, then I will definitely be here doing the live stream and giving you the update that you need. All right. Take care and thanks so much.